For many investors, 2025 felt like a disappointment for crypto. Institutions entered the space. Regulation became clearer. Adoption kept growing, yet prices went nowhere. Liquidity dried up. Meanwhile, tech stocks and precious metals outperformed. So what went wrong? According to macro-focused analysts, the answer is simple and uncomfortable for many crypto investors. Crypto did not fail in 2025. Liquidity did. And that's exactly why 2026 could look very different. Liquidity is what actually drives crypto. Bitcoin and the broader crypto market are not driven primarily by hype, headlines, or even adoption. They are driven by global liquidity. When money is easy, when capital flows freely through the financial system, risk assets rise. Stocks, credit, real estate, and crypto. When liquidity tightens, the most speculative assets are hit first. That is exactly what happened in 2025. Despite positive news, fiscal constraints, political gridlock, and rate uncertainty pulled money out of the system. Capital retreated to safer assets. Crypto, sitting at the far end of the risk curve, absorbed the damage first. Bitcoin didn't weaken because its fundamentals broke. It weakened because capital flows turned against it. Why 2026 is shaping up as a turning point? Now let's look at the bigger picture. Governments around the world face a massive problem: debt servicing. Interest payments on existing debt are exploding. Rolling this debt forward requires a huge injection of liquidity, estimated at $7 to $8 trillion over a relatively short period. This liquidity is unlikely to come from simple rate cuts alone. Instead, it is expected to arrive through regulatory changes, adjustments to bank capital rules, balance sheet engineering, fiscal stimulus tied to debt refinancing. When banks are incentivized to absorb government debt, use it as collateral, and expand lending, liquidity spreads through the entire financial system. Historically, this environment has been extremely supportive for Bitcoin. Fiscal policy is now in control. Another major shift is happening beneath the surface. Central banks are no longer the only drivers of markets. Fiscal policy has taken the lead. Governments are prioritizing economic stability and debt management, even if it means expanding the money supply. Call it what it is: currency debasement, wrapped in technical language. Bitcoin was designed for exactly this environment. A digitally scarce asset, immune to political dilution, increasingly viewed as a hedge against long-term monetary erosion. Why 2025 felt so confusing? Many investors asked the same question last year. How can crypto have good news everywhere, yet prices keep falling? The answer lies in timing. Adoption advanced. Regulation improved, but liquidity moved in the opposite direction. Treasury cash rebuilding, budget disruptions, and renewed trade tensions drained money from markets. Crypto became collateral damage, not because it failed, but because capital went elsewhere. Bitcoin is usually the first to react. When liquidity returns, Bitcoin historically responds first. It is the most liquid, the most institutionally accessible, and the easiest way to re-enter risk exposure. Typically, Bitcoin leads, and only later does capital rotate into the broader crypto market. Smart contract platforms, infrastructure tokens, and higher-risk assets usually follow once confidence improves. Tokenization and the next phase of growth. Beyond Bitcoin, the long-term opportunity is much bigger. Tokenization of equities, bonds, commodities, and real-world assets represents a market far larger than crypto alone. As financial instruments move onto blockchain rails, demand grows for security, settlement, block space, decentralized infrastructure. That demand creates structural value for blockchain networks and their native tokens. AI and blockchain are becoming interdependent. Artificial intelligence accelerates this trend. AI systems need data authentication, micropayments, decentralized marketplaces, real-time settlement. Traditional currencies are not designed for constant microtransactions between autonomous systems. Token-based systems are. This is where blockchain quietly becomes essential infrastructure rather than speculation. Risk never disappears. Even in favorable macro conditions, crypto remains volatile. Bitcoin has always experienced sharp corrections, even in strong bull markets. The difference is that each cycle has historically established a higher long-term floor. More speculative tokens will always carry greater risk and greater volatility. A smarter way to get exposure. For investors looking to position ahead of a potential liquidity-driven phase in 2026, access and risk management matter. Some platforms now offer copy trading, allowing users to mirror experienced crypto strategies instead of trading actively themselves. One such platform is Bitfinex, which combines crypto access with copy trading tools and deposit incentives. This approach can suit investors who want exposure without managing every trade manually. Final thought. The outlook for 2026 is not about hype. It's about liquidity, fiscal dominance, and digital infrastructure. If liquidity expands at the scale many expect, Bitcoin and the broader crypto market are likely to respond not because risk disappears, but because capital once again seeks scarcity, decentralization, and global accessibility.